Welcome back to another episode of the LSCRE Podcast. You've got Rob in frame guzzling down a litany of exotic supplements, trying to get better. He's not a drug head, so get that out of your frame, obviously, if you're thinking that way. No PEDs either, not an Adderall abuser. But alas, we are here to go through a very jam-packed episode.
I don't even drink caffeine.
Yeah,
No
doesn't even drink
coffee.
caffeine.
No alcohol.
That's why. Well, obviously he's not in sales for that reason. Unlike this caffeine degenerate.
Stimulant addict.
Yeah, exactly. But without further ado, if you're a data junkie, you're gonna absolutely love this episode. We're gonna be talking about the Newmark Q3 2025 update. Those who are data driven and we make our decisions really based off a lot of the fundamentals we see. And I think this is actually some more encouraging information, some more tailwinds, and probably a nugget or two along the way. Before I do get into that, I want to actually spotlight and advertise something real quick. Number one, it's great to work with a sponsor like us who always keeps you up to date with the latest and greatest things going on. So specifically here, we have not only within kind of our breakdown, our monthly emails, you kind of get some, updates on our property, stuff like that. But number one, we've got a webinar coming up, the second live webinar on December 4th. So please be there, 2 p.m. Eastern. But I just wanted to advertise and toot our horn for a second. So naturally, operations has been the forefront of probably the most kind of important thing we're looking to improve on right now. I would say it is single-handedly what kind of Rob, I would say, is kind of focusing most on, particularly with dialing up the best possible systems, with moving to Houston over a year ago, to kind of building out that side of the business. So I just kind of want to highlight a couple of notes here. So portfolio highlights you see here in this newsletter. Houston 3-property portfolio, the 3-pack Beckley, Highland, and Meritage, has a stabilized blended occupancy of 95%, which is awesome. Five Oaks here, it achieved record low delinquency of 0.76%, so less than 1 point. And then Lakes at 610, which is another property tax exemption deal that we've done, is operating 60% under budget for repairs and maintenance expenses, driven by a vertically integrated maintenance team handling work in-house and generating meaningful cost savings. So that property was kind of a cool value add in many respects, but not the cookie cutter value add. So we're achieving value add there by our vertical integrations, because our in-house management team does things for substantially better than what a third party person would do from a cost perspective. And then obviously the tax exemption on that deal is also creating some sweet juice there as well. And Rob, if I'm not mistaken, the cash flow one and the financials are looking really awesome. And I believe our webinar coming up, the live one on December 4th, will also be going into kind of a case study about the financials and stuff like that. But just for Lake 6610, maybe there's some investors or partners working with us on that deal. Can you kind of break down some of the things you were telling me offline a week ago or so about where performance is trending to?
Yeah, another interesting thing to mention about Lakes at 610 is this is one of the Cortland acquisitions last year where we purchased the property out of a REIT structure. And so a REIT is a real estate investment trust. And basically, for tax purposes, that property was held in a private REIT. And we purchased that property actually not as a property, but as a corporation, right? As a REIT corporation. So it was actually like a corporate purchase. So we bought the entire company that held the property. And then shortly after closing, we unwound the holding company. So that way we could get to fee simple ownership, because at the end of the day, we're in this business to own real estate directly with our investors. And so that investors can also benefit from the direct real estate ownership benefits, because sure, you can go out and buy a stock in the public markets, you can buy a REIT, and you can get exposure to real estate that way, but then you miss out on the benefits of direct private real estate ownership, namely depreciation, 1031 exchange, and that's exactly what we're able to deliver on that deal for our investors as usual. But the cool part about the REIT acquisition is it weeded out a lot of buyers, because it was complex and it was more costly, more difficult. And so we were already a proven commodity because we had actually just recently closed another REIT acquisition. So we had experience, track record to where we could show the seller, hey, we know how to close these. You know that we know, so let's go. And that's how we're able to get the deal at a not even necessarily the top price. And our reputation continues to precede us, and where we're able to participate in hotly contested biddings for acquisitions, and we're able to win not necessarily at the highest price, but because of our track record and our reputation and relationships that we have in the market. So, yeah, just want to mention that piece. As far as operations go, as you showed in that highlight, we're operating Lakes at 610 well below budget when it comes to repairs and maintenance. And that's really cool. And I think one of the reasons for that is because of conservative underwriting. The other reason for that is, as you mentioned, our vertical integration, where we're able to just tackle routine maintenance. We're able to tackle deferred maintenance, CapEx with our in-house teams. And right now, when we have turns, which means when a unit becomes vacant and we need to prep it for the next move in, that's one of your biggest maintenance costs, turnover cost, right? So in order to reduce turnover costs, you can try to go for higher renewal rates. And that's, to me, the holy grail. That's the best thing that you can do. If you can have positive rent growth on your renewals and you have a high renewal percentage, that's the best sign of healthy performance and the best way that you will get cash flow. So, but in lieu of pushing for renewals, you can also just simply reduce your costs associated with each individual turn. And that's what we have at Lakes. And one of the exciting reasons for that is because it has all granite countertops and has new garden style bathtubs for the showers. And so these things, so you don't need to resurface granite countertops like you do with Formica, which need constant resurfacing and never look good as granite. And then the other piece are the bathtubs, which need constant resurfacing. And with these units, because they're left in good condition and because they have these higher quality materials, the turns, there's almost nothing to do, right? There's no resurfacing, there's no countertops. We don't really have to do much. Obviously, we
Maybe
might need to
carpet,
do
which is super cheap.
you do carpet, you do we since we have vinyl plank luxury vinyl plank flooring, you might have to replace a little bit of the flooring there,
Super
do some
cheap.
touch up paint, and ideally nothing too crazy, and that's that way you're able to keep your turn expenses very low.
Yeah, and we're going to talk about this because the Newmark report that we're going to go into today actually covers that. But renewals are king. We're all in the business looking for the tenant who would rather stay on site than leave somewhere else. Although you might get potentially a rent bump, you'd rather keep the tenant in place when you factor the costs associated to that person leaving. But we're going to get into that, and that's obviously been a
Yeah.
theme if you've been listening to this show or been keeping yourself, abreast with the latest and greatest information within the market. Coupled with that, obviously, Lakes at 610 has got a really cool unit mix, and it's also in a supply constrained area because you can't really build much in the med center anymore. So those are things that we look for. Those are things that have been more successful, which is super exciting on our end. But the final note on that is our expenses have been so awesome and under budget. And the irony is when we acquired that deal, one of actually the family offices that worked with us in that investment gave me and Brad, who were telling them about the deal, a lot of pushback on the savings there. And then, although we felt it was conservative in line, they were still not, that was the one thing they kind of gave us grief for, that they didn't really, I guess, believe in the projections, but they holistically obviously have worked with us before and they invested in the deal. Well, it's really cool to come back here to say, hey, not only are those projections, were they conservative, but we're actually beating them. And that's one thing that we can bring to the table that few people can. And also every business is ran a bit differently. And it's hard just to believe, others that say, oh, we're going to cut all these expenses, because a lot of times, it's kind of a bogus way to do it. But when it comes to us, we now have a proven track record, and we're going to go on further case studies to display that competency and our ability to do just that, run things very efficiently, with the right principles in mind for tenant satisfaction and for on-site team success.
Yeah, so let me highlight that and sell the upcoming live podcast. So for those of you that joined the live podcast recently, thanks for joining. I hope you had a good time. And for those that caught the replay or the recording after, which was available on YouTube and everywhere else, Hopefully you guys enjoyed that as well. So this upcoming live podcast is going to be an expense optimization case study. We're actually going to be looking at one of our properties that we purchased from Cortland, which is a top 10 national owner in the country. They own almost 80,000 units, so they're extremely reputable. They have a great reputation. They really do run their properties super well. It's a pleasure to work with them on the transaction side. It's also a pleasure to take ownership of their properties, basically buy from them. And that's something that as you get more experience in this business, you don't take for granted, because you can buy from the wrong person and
I'm
you just
laughing
continue.
because we've had the tale of two cities on that one last year.
Yeah, you continue to get the not so joys of buying from the wrong person, because you continue to uncover more and more skeletons in the closet, and you can do a bunch of due diligence, but you can't uncover everything. So when you buy from someone who is reputable and who actually really puts a lot of money into their properties, like Cortland does, it's a joy to own these properties after they dispose of them. So that's fantastic. And so currently, Cortland has another deal for sale right next door to
That I
uh,
want.
a property that we own and have
More than
owned
the
for over
other.
a year now from Cortland. And we're going to be doing a case study where we now have their previous financials for the property that we acquired. And now we have a full year of our own financials of running the property. And we can compare those head to head. And then we can also compare the financials of the property down the street and see how things are running head to head versus our way of operating. Like you said, everyone has their own way of operating. And, there's a lot of benefits of being as big as Cortland and having an institutional platform and having 80,000 units. But at the same time, there's also benefits of being small like us and having 5,500 units and being vertically integrated and being boots on the ground and nimble. And we can run at much lower expense loads and really deliver better cash flow for investors. So that's what we're really striving to do. And you got to be great on the revenue side. You got to be great on the expense side. You need to finance conservatively. And those are all the things that we're aiming to deliver for investors.
Yeah, no, it's not a one size fits all equation for us to create value, which is, I think, why we're one of the most cutting edge firms within the country. But hey, we got to brag about ourselves, because if we don't, who will? Although we do have some raving investors that love to toot our horn, but sometimes you got to let them know as well. Okay, on to the main purpose of the conversation. If you're another operator listening to the show, sorry we were bragging for that long. Sorry that I'm not sorry, I really should say. But let's get into the topic of conversation here, which is Q3 2025 U.S. multifamily capital markets conditions and trends by none other than Newmark. Okay. So, Rob, if you want to read some of these things here to go through it, your reading is a little more proficient than mine. But number one, I'll just go on this one and then I'll let you go from there. But this one's near and dear to us. This is the spread of renting to ownership. The first thing, renting remains significantly more cost effective than home ownership. They're going to hear some stuff, whether it be us or other podcasts. They kind of hit on recurring themes. But this is something that we really can't understate enough. Okay. So the spread has never been actually wider in the history, which is super exciting, obviously. As one third as of Q3 of 2025, the spread between homeownership, renting costs totaling 1241, representing 2.7 times the long-term average of 457. The elevated spread highlights significant affordability challenging facing potential home buyers. Not a good sign if you're a realtor, if you're a lender, if you're a title agent, if you're in the home service business. Very tough, but an incredible sign for our business, just for long-term sustainability and tenant retention there, because there's not much of a threat to homeownership right now, as there has been in other times. Although Jay Parsons does talk about this, there is a correlation between the housing market being on fire and apartments doing well. But that's probably just generally a market beta circumstance there. But holistically, stuff like this, that's probably better for the exit market. But for the buying market right now, for its sticky tenant base, this is awesome.
I think this is a tired trope.
Yeah. Figured you probably didn't love it.
Yeah, I'm not, to me, this is like slop. This is like 101. What's going on in the market? Oh, home ownership's so expensive. Renting is cheaper. People are going to be staying out of the home ownership pool for longer. You've got more demand from residents. This is what we would say to someone who is new to this business. But obviously, we have so many experts listening to our podcast every week. I don't want to bore them with this.
Hey, listen, we have new investors that inbound from RBC Bank who work at Brookfield, and we've got people who, are farmers who may not be as financially sound in the spreadsheets, stuff like that. And there's nothing wrong with either of those people, but we try to accommodate to everyone. In the same vein here, new mortgages 53% greater than in place. Essentially, this is, kind of the same vein, but the average mortgage in place, which I did find interesting, was about 4.11%. And then new mortgages at about 6.3%. So just makes it very challenging just from a payment perspective. You're talking about a pretty big drastic pace, and that's exactly why, as alluded to here, why this spread is so high, right? The renter here effectively can rent for $11.88 nationwide. A new mortgage is about $31.21. So just something to consider here. And obviously every market that is different. But obviously kind of in vein there, similar kind of conversation. Purchase applications remain weak as customer home buyer sentiment is depressed. Yes, more of the same. We know that home purchases are completely down.
I thought it was very interesting what the FHFA director said about having your mortgage being able to go with you. That
Yeah.
that
Well,
makes
we'll talk
a
about
lot of
that
sense.
actually. We'll talk about that actually next week. We've got too much to unpack here. But yes, that is definitely interesting. It's like the portable mortgage essentially.
Yeah,
Although,
portable mortgage, it makes a lot of sense. I mean, if you're PGing the mortgage, right, it's really like a loan on you, not as much the home. So being able to bring it with you, it's just going to spur transaction activity so people can move if they want to.
the question is, though, are you need a supplemental loan if you need to go up to kind of segue that, or do you get a blended mortgage potentially? That would
I
be
mean,
some logistics. That'd be
sure,
the
you would if you need one, if you qualify for one, you could get a supplemental, I'd imagine.
yeah. Um, renting housing continued to benefit from
Do you want me to
stubbornly.
read these?
Yeah, sure.
Uh, okay, rental housing continues to benefit from stubbornly elevated home prices. So, as of the third quarter of this year, S&P CoreLogic Case-Shiller U.S. National Home Price, that's word salad for basically how the housing market is doing. It totaled an arbitrary number, which is 327.1, increasing 1.5% year over year. So basically, we could have just simplified all that to just say home values are up 1.5%. While this represents the lowest price growth since July 2023, home prices continue to keep the market in check. The moderation in price appreciation offers limited relief to potential buyers as affordability remains severely constrained by elevated home values. To me, this is like, again,
More of the same.
this doesn't even say anything. I'm not loving this report.
Leasing market.
Strong demand shows signs of cooling following historic surge. So I don't know about this. I think this is just lagging data. Because if anything, this happened a while ago. So I don't know. Maybe this is just like a small pullback. Maybe I don't really. I mean, I guess the one argument or the one mathematical point is if there's less supply, there's less that can be absorbed. So absorption can actually go down when there's less supply, but it's still a good thing. So lower absorption, but actually still better fundamentals. But a lot of people consider absorption as kind of like the holy grail of supply demand fundamental metrics, but it
I'd rather
actually
be
gets
no
distorted.
absorption because that means that there's no leases or no new supply almost, right? To your point.
Well, yeah, you'd rather have no new supply and there still be absorption because that just what that literally means is person for person occupancy increases, right? If you have 100 units and none are being added to the market, so you have 100 units and you still have 100 units, but you absorbed 5 units, I mean you just accreted 5% occupancy.
Okay. Seasonal leasing patterns shift in post-COVID era. Nothing too exciting there. This is an interesting one. I mean, regional demand still led by South, Midwest, and Northeast increase year over year. Essentially, people are flocking to certain geographical locations. It's kind of known that the Midwest has kind of been a sleepier market. Not sleepy in the sense that no one's there, but it just kind of grows very, very slowly and organically over time. There's not a lot of net new migration, but there's just, birth rate and stuff like that that kind of propels the incline of people there. But it is, interesting to see that the South still has the most demand. Whether it be the Sunshine States or South Florida, Southeast area.
But this isn't really that. This is a misleading chart if you interpret it that way, because it's not saying, in my opinion, that the South really has more demand, because that doesn't really tell me anything. If you look at the trend since 2010 on this chart, it kind of is like everything is the same, like nothing has changed. So the South continues to have a 50% share because it's just big and there's a lot of units and a lot of people. And then the Northeast continues to have around a 10% share and nothing's changing. So
Things
you have all
really
these,
don't get built in the Northeast.
you have this crazy, well, this isn't about building, it's about demand. And the share of demand across these different places. So I mean, to me, this is actually kind of contrary to this whole narrative that you have this flight from the coast over to the South or the Sunbelt states. This chart doesn't actually show that at all. It shows that, demand as a percentage, as a pie chart, it's kind of all the same. Like this is still, if there's 10 people, 5 of them demand to live in the South, 2 of them demand to, or, 1 of them demands to live in the Northeast, 2 in the Midwest, and
1 in the Northeast,
1 in the West. So we have 1 in the West, 1 in the Northeast, 2 in the Midwest, and 5 in the South. And that hasn't changed over the last 15 years. Kind of, you saw this crazy spike in COVID, and then everything's just back to normal again.
Moving on.
Well, let's see here. I also don't like this chart again. Annual demand as a percentage of existing units. Well, so it says Phoenix, for example, has annual demand as a percentage of existing units, 7%. Okay. But also this doesn't take into account supply, right? So there might be demand as a percentage of existing units, but what is annual demand as a percentage of existing?
Too, looking at these, like the 3 over here, Charlotte, Austin, and Phoenix, are quite literally some of the 3 worst markets in the country. As we went through the other market on the last live podcast, those are quite literally some of the worst markets to be in, right?
Yeah. No, I'm super disappointed in this chart and in this whole report. Like, this is the worst. That's the worst chart I've ever seen.
It's nothing to you?
It just means nothing to me.
Yeah.
I hate it.
Very good.
It's kind of like I just watched Neil Bawa's market webinar over the weekend. I hated it.
What is he selling? What is he selling now?
He says, "Oh, buy in small markets. I wouldn't invest in major markets. I'd invest in small markets because
I feel like everything he does, it's like 2 years too late,
or too early, just because it's a cycle." But it's unfortunate because people are watching that webinar and they think that it's a good idea to go invest in a small town because there's a lot of population growth in that small town. But real estate is not data science. You're not just sitting behind a desk and trading stocks. You actually are living and breathing the real estate. You have to operate it. You have to own it. You have to love it. And so there's so much more to investing. Like Neil wants to hop from market to market based on what has the best data. But I don't view real estate as stocks to be traded on a year-by-year basis. I view them
you want to be early like that to capture the upside. Once that information's out there, it starts to get priced into the market.
Well, that's the other thing too. All his data talking about growth, it's public information, and he stresses on the webinar repeatedly, this is public information. This is public information. And so to the extent that something's public, it's going to be priced into the fundamentals, into the pricing, right? So like everybody knows that Elon Musk is a great CEO, and everybody knows that Tesla is a good company. But what makes Tesla stock a good investment or not is if its price relative to its prospects are a good buy. And if the entire world is obsessing over Tesla stock and it's priced as such, then it's probably not a great stock investment.
No value, right?
Yeah. So it's very difficult to, it's kind of like the worst of all worlds to say, I'm going to invest in a small market, which inherently has more risk and it's more difficult to operate in. Plus it's consensus because it's high growth and everyone wants to be there. And there's going to be limited opportunity. So like if you like, Salt Lake City, which actually that'd be the best small city example, right? That's the best small city in the country for sure to invest in multifamily. But there's going to be how many multifamily trades per year? There's going to be 10 properties that trade hands, and they're probably all going to just trade between the people who own in Salt Lake, all the rich Mormons, and you're never going to be able to break in and get a chance. So it just doesn't make sense.
Yeah, well, I actually do like this chart here. This is one graph, which it's a little bit misleading here because on one hand, you see annual supply of units, but on the other side, you see the annual growth amount, right? So you see Houston, for instance, which is our backyard, has got what would look like, in relative to a market like, let's say, Pittsburgh, a lot. However, when you look in relation to the percentage, statistically speaking, for a big city, it's not that much. Similar, New York is there, right? It's roughly 1% of supply, but it's 25,000 units, which is technically a lot, right? Well, not when you kind of extrapolate it further. So this, to me, is a little bit better. This is probably the best graph so far, in my opinion.
Yeah,
You got
kind of. I mean,
Dallas.
it's the bar chart portion of it is meaningless, but the circles are meaningful, right?
Correct.
Because it's like, if I told you, hey, I'm investing in this amazing market, it has 200K population growth over the last 5 years. You say, well, I have no idea what market you're talking about, and therefore I have no idea if 200,000 people is a good number or is it a bad number, right? It's all about percentages. So same thing here, right? The
Yeah,
bar chart.
Phoenix. Yeah, it goes back to like Phoenix, Austin, Charlotte being some of the worst markets, as we mentioned before, from these stats right here.
So the other thing to note, because I just talked about how you can't have value, like value is not divorced from price, right? So if you're talking about, oh, let's invest in this market because it's really fantastic growth, well, it's like, oh, what is it priced like? And so it kind of works it works exactly in the opposite as well when you're looking at what you just called out. If you just look at the circles on this chart and you look at everything that has the highest supply as a percentage of inventory, right? So basically, highest annual inventory growth percentage, those markets are Phoenix, Austin, Charlotte, and then everything else is kind of a step below it. But those are the high
Raleigh, Durham,
flyers.
by the way, which is Carolinas, obviously not good as well. So tons of supply there.
Denver is high,
Denver's very high. Salt Lake's a little higher than you'd like.
correct? And then what's this one? Nashville's very high. So
Nashville's
those are
pretty heinous
those are the high
too.
ones.
Yeah.
So in the inverse though, you
Tampa, Orlando.
hmm So what you'd have to ask yourself and understand and price in when you analyze these markets is you'd have to say, okay, we know that the supply story is horrible in these markets, right? These markets are super oversupplied. And what does that mean? That means that you're going to have no rent growth, you have declining rents, you have high concessions, which means that if you properties are routinely offering 1 month, 2 month, even 3 months free, which is a 25% discount on your revenue, right? And you cannot break even on cash flow when you have those sorts of fundamentals, depending on your debt basis and all these other things, but just kind of generally speaking. So the point I'm making is you have to understand all these fundamentals and you have to price them in, and then you have to see, do the prices reflect it? Because just because you're saying these are horrible markets to invest in, but that is only true if the pricing does not reflect these fundamentals. So for example, in Phoenix, right? Phoenix has terrible oversupply, therefore terrible rent fundamentals. But if Phoenix were trading at an 8 cap, we would be on this podcast talking about how Phoenix is the best market to invest in,
Or if we could
guys.
get Class A for positive leverage, right? If we could get Class A for positive leverage, or
Well, that would be an 8 cap.
yeah, well, okay, well, even if
Well,
it was,
because you'd have to pay an 8 cap because you'd have to then underwrite a 25% decline in rent for the first 2 years. So like your 8 cap that you're buying is really more like a 6 cap.
well, even if you get Class A for like a 5.5 or a 6 cap, would be still kind of a make you think situation. But unfortunately, it's almost trading below a 5 right now at the moment, which is nearly impossible to make sense of.
Yeah. So that again just goes back to the concept of, value is not divorced from price, right? You have to know what things are trading at. So unfortunately, Phoenix is not on sale in spite of its bad dynamics. So therefore it makes it a bad buy. And when you're kind of hunting for opportunity or distress, right? Whether you're looking for high growth, great fundamentals, or you're looking for distress, turnaround play, both of them, either way, ends of the spectrum, they need to be priced appropriately given the circumstances.
Supply, nothing to go and harp on further, but we all know that deliveries are going to cool off substantially. But you see here kind of peak delivery unit starts here was pretty heinous in 2022 and stuff like that. Those are being delivered now, and that's obviously creating a lot of problems in the marketplace. Nothing to go further on that front. Vacancy is starting to trend better of late, which is obviously good for absorption of units, things of that nature, and also just overall fundamentals. Did you freeze there?
I dropped out.
Yeah, no problem. Vacancy drops more. Nothing we didn't know there. Rent growth turns year over year. So basically, rent growth has been flat in a lot of markets, some places better than others. But I do believe that we will start to probably experience rent growth. When would you think, Rob? I think starting probably 2027 in most markets, or at least it's flat, but 2026 in some as well.
Yeah, so that's a great question. And to answer that, I think we'd have to actually go back to the previous chart, which shows the supply. If you go actually one more chart up, or a couple more charts up, I guess I fell off this a while ago. You go up back to the supply. Here we go. So basically, the lower the supply as a percentage of inventory. So if you're watching this with us on YouTube, if you look at those circles, the lower down the circle is to the bottom, that's when rent growth has already started or is around the corner. So if you look at places like San Francisco, Pittsburgh, Detroit, Oakland, San Francisco, or did I already say San Francisco? I mean, Chicago, Los Angeles, bunch of places that you would not normally think of as high growth markets, like St. Louis, Cleveland, Greensboro, Cincinnati, Orange County, Sacramento, Baltimore. These places all have positive rent growth right now today.
Yeah, we'll actually get into that at the end. I think there's
a
chart.
Right, and then if you look at the inverse, like let's go beat up on our favorite punching bags like Phoenix, Austin, Charlotte, right? The three most oversupplied markets in the country. I would say rent growth is not going to be positive until, I don't know,
28, 29?
Probably late 2027. Maybe. Probably something like that. So, yeah, that's kind of your spectrum.
And then going here, more of the same. Rent growth year over year is basically slightly below 1%, but obviously some pockets are better and worse than others, like anything. And then here is a good chart talking about rent growth concentration. To your point there, see, but I do think this is a bit misleading because this goes from 2015 to 2019 average. Well, San Francisco actually during COVID and stuff had a complete regression in rent. Other places skyrocketed, and now it's higher. It's okay. Well, great. You took a step backwards, and now it's kind of finally catching up a bit. But nonetheless, San Francisco has been doing well of late. Chicago's been doing well of late. New York is actually humming right now. I've heard New Jersey's doing pretty well. San Jose's doing well. And then the typical staple punching bags over here, negative, what is that? Almost 6%, 7% close to that. Denver, Austin, Phoenix, which by the way, other than Austin, we'd probably want to buy in Denver. We probably want to buy in Phoenix. And I know we want to buy in San Antonio. But these places are kind of the punching bags of the markets right now. So tough sledding there.
Yeah. So to interpret this chart for everybody, the circles now on this one are the 2015 to 2019 average for rent growth. And then the bars are current rent growth. So, or year over year rent growth. So what you're seeing is markets that have historically been, many of these, well, really there's not that big of a trend, funny enough. So, because what I was going to say is that basically the markets that had enjoyed strong growth got overbuilt and then therefore are deeply negative. But it's really not that dramatic of a difference. And I think maybe in part that's just the scale of the y-axis here, because the difference between 2% rent growth compounded over 4 or 5 years and 5% rent growth compounded over 4 or 5 years is a world of difference. And so this chart doesn't really fully put that into perspective to allow you to appreciate that, just because the y-axis goes from negative 10% to positive 10%. So it kind of crams down this spectrum. But, if you look at like San Francisco, it historically looks like is about 3.5% rent growth. So really fantastic rent growth market. And then right now it's really having its renaissance at 7.5% rent growth. So that's fantastic. And then you look at a market like Denver, which also similarly has had 4% rent growth per year in 2015 to 2019. Awesome market. Right now it's like negative 8% rent growth. And those numbers are probably even understated because I don't think that these year over year rent changes fully take into account all the concessions apparent in the market. Because there's ways to, and it's hard to collect all that data and fully factor it in, but just, the brutal effect of a concession is is hard to fully appreciate. 1 month free on a 12-month lease is an 8% rent discount. And two months free is almost 17%. So these are massive discounts, which then would, I think the true number here would be more like negative 10% rent growth, negative 15% rent growth, negative 20% rent growth in certain circumstances.
Agreed. Moving on here, just more of a theme that we've been talking about here, but renewals are especially accretive, but essentially the thought here, especially for a tenant, I just want to kind of conceptualize this once more. If you're a tenant, moving probably costs, a couple $100 to maybe $1,000. And when you move into a new unit, depending on kind of the class that you're in, you've got to do first month's and then a security deposit, things like that, as opposed to staying in place in your current unit. You don't have those moving costs, don't have those moving fees, and maybe you get a little bit of a rent bump, even if it's going from, call it, for round numbers, 1,000 to 1,050. That's still probably cheaper for you to do over the course of things as opposed to moving to a new unit.
It's great. It's a win-win. Landlord wins, tenant wins. If you provide a good place to live and they are happy as well and they renew, landlord saves on turn costs, tenant saves on move costs, and it's great. It's a tough pill to swallow for existing residents to see a property advertising online cheaper rents than what they are paying at the property already, or if the property is offering a move-in concession saying, hey, for new residents, if you move in today, we'll give you 2 months free. And then a resident who's a happy, good paying tenant, their lease is up for renewal, and they're like, hey, well, why are you willing to give some rando off the street 2 months free, but for me, you're trying to raise my rent? This is insane. And so it's very difficult to balance new leasing activity versus renewals, and you kind of need to be diplomatic about that and also reasonable and realistic. And so I kind of have a tenant friendly perspective on those sorts of things.
Your
And I think you
concessions are a
should,
killer because once people hear and breathe and smell concessions, it's being advertised. Your current base is going to start asking for those as well.
yeah. And you should value, in my opinion, you should value your existing tenants more than new tenants.
Completely agree. Nothing really too new here, but essentially, first half of this year, first quarter, and really just recently, the market's been incredibly slow. We've been very fortunate and blessed to have the ability to do our unique angles to create value, such as tax exemption opportunities, where we've been able to make deals penciled that would otherwise not, that also have terminal value, which is super awesome. That also help the tenants. But for most people, not a lot of purchases occurring. However, of Q3, those numbers actually started to increase compared to other Q3s. But you'll notice here, 2021 and 2022, so much transaction volume occurred that there was kind of going to be a whipsaw effect at some point, and obviously we're experiencing that now, coupled with debt and other supply issues, and people not really wanting to rush to sell and lose money. But it is just crazy. And obviously this is slightly skewed because inflation. I mean, it's kind of hard to take these kind of past numbers into serious effect because these properties have appreciated as much as they have, and the business is just kind of explosive apartments and stuff. So that is a bit of a skewing thing, coupled to the fact that the pricing was very depressed back here. But if you go kind of to more modern era, obviously a lot more deals were done in 2018, 2019. I mean, it's crazy to think that that's the number of billions, excuse me, considering the fact that, prices have almost doubled since that time.
Yeah. And so this is debt origination, which is not the sales picture because obviously a lot of refinances are in here, not just financing activity upon sales/acquisitions. But if you look at this, volume is a proxy for price. The more volume that's happening, the higher prices go. And so the peak of volume is the peak pricing, generally speaking, roughly speaking. And so this is borne true here when you look at peak volume actually happened, at least debt origination volume happened in Q4 of 2021, 150 billion. So that's the highest in any quarter in recorded history, or at least in this chart. So it's you wouldn't be wrong to say, okay, well, Q4 2021, that was the peak for multifamily. So then let's look at, okay, well then what was the bottom, right? The bottom would then simply be the trough in terms of volume. And so if you look quarter by quarter, the bottom is Q1 2024, 46 billion. So that shows you basically the bottom happened somewhere kind of in 2023, early 24. People are asking, oh, where's the bottom? Where are we in the market? This chart would argue that the bottom was somewhere in 23, probably, in my opinion, late 23, early 24. That's kind of generally the bottom here.
And then one thing I did want to talk about is, maturities coming up. So the lion's share of maturities are actually bound to happen here coming up in 25, 26, and 27 from this perspective here. So
this is cap.
You don't believe so?
No, I mean also does this chart, like, take the narrative out? Does this chart really show you a trend? It kind of looks to me like a bunch of bars that are about the same size. Yeah. So it doesn't really seem to me like, oh, we have this wall of maturities looming.
Well, I agree with that. Like,
I know. I'm not trying to take against you. I'm just taking the other side of the narrative, right? The consensus narrative is, for years, people have been saying, there's a wall of maturities, there's a wall of maturities. And it's just very logical that you would have the most maturities coming up, because you have the most
deals were done back here. So no duh.
Well, not even that, right? It's just because you'd have the most amount of maturity happening now because you financed deals for over the last, 2, 3, 5, 7, 10 years, and all those loans are coming due. And then as you look out, right, there's just less deals that have gotten done. So, and less deals that have yet to be done, right? So these bars that are in 28, 29, 30, 31, 32, 33, these bars are going to be bigger as time goes on because there's going to be more financing that happens in 26, 27, 28, 29.
Like every deal that we've done from 23 to probably 26 will be sold in the 28, 29, 2030. So I do agree wholeheartedly with that.
Not necessarily just sold, but just the loan is going to mature. It's going to technically mature, right? Because this is tracking
a capital event of sorts.
Yeah, or not, because as we've seen in 24 and 25, right? So this year and last year, we've seen plenty of deals mature and nothing happens. So a maturity is not this wall. It's more of like a narrow hallway. So you don't just slam into this wall and die, right? It's a narrow hallway to where you kind of now have to squeeze through this thing, and it's uncomfortable. But if the lender doesn't foreclose because your maturity defaulted, then you continue to just ride along in that loan, or you do a loan modification, or you do an extension. And so to the extent that there is distress, which there is a ton of it, it's kind of, well, literally the next slide is stealing my bit right here. Distress suppressed by widespread use of extension options, but distress is building. And so that's the thing, because there's all these outlets for the distress, right? It is avoiding a catastrophe moment where, because if all these maturities and all this distress was forced to hit the market all at once, it would overwhelm the market and there'd be way more sellers than buyers, and that would push pricing very low. It would be very negative for pricing. But because the distress is being spread out over 2023, 2024, 2025, 26, 27, 28 even, you're just trickling out that distress. It's really not going to offset the market very much.
Yeah, I also think that with all these other funds is that we're just not going to see, skies falling, 8 caps, 9 caps. And it's kind of funny talking to investors who, have been investing in the space that are, 50 plus. So yeah, well, I like this deal, looks good, but I kind of like when the deals were 7 and 8 caps and 9 caps. It's like, that's just a stupid comment, because those days probably not coming back if you're in a growth market ever. Capital flows are just going to fewer buckets and are going here, and housing is so stable. So it must have been nice, and you probably should have held those properties if they were so good, or done it yourself in that sense. But those are just not realistic fundamentals that are occurring anymore. And it was really easy to make money in this space beforehand, I guess, is the moral of that story.
What's interesting about the chart on the right is, and I don't know if I can really interpret this accurately, because this chart is somewhat meaningless without knowing percentages and or historical averages, because gross dollar volumes, I just don't know how big the office market is in total. I don't know how big the multifamily market is in total. So showing that there's more debt past original maturity date that's still outstanding, and office and multi are about the same, and then everything else is lower. I can't really interpret it, but if I were to have a working hypothesis, I would say that multifamily got way overheated and way overfinanced. And so now a lot of these bad loans are bad because the property is not worth the loan amount. And so actually the funny thing is when the property is worth less than the loan amount, the borrower has more negotiating power over the lender, which is funny and counterintuitive, but it's true. Because if let's say a lender lent $50 million to a $100 million property and the property was in default, the lender would simply just foreclose on the asset and then sell the property for 100 or 90 or 80 or who cares how much, and they'll recoup their $50 million loan. But if the lender made a $50 million loan and today the property is worth 40, the lender is going to be less motivated and incentivized to foreclose on the property, because then if they foreclose and then fire sell the property, they're going to take a 20% loss on their principal. So the lender would rather just basically have an asset manager for free, which is the borrower now, manage the property, and they can kick the can and they can extend and pretend and not have to actually write down their principal at all, even if today the property is worth less than their principal. So that's why I think you have a lot of multifamily that is outstanding debt, even though it's matured. Office, same thing, but in a very big way, because we all know that the Class C office space is way underwater. None of these loans are good. All the properties are worth less than the loan amount. And
They're
so
essentially useless now.
Yeah, and so the lender doesn't want to take it over, because what's the lender going to do with it?
Final thing I want to talk on and mention this because we got to get on to the next. But essentially, San Jose leads U.S. in returns among strengthening West Coast markets. Any way you slice it, total analyzed returns. Just wanted to point out one little thing, which is Houston here. That's all. Just want to toot that one real quick. Rob, thank you for breaking this down for the listeners here. We appreciate you, and we'll see you next week. Make sure to attend our December 4th live webinar.